If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Real GDP expanded by 3.9% year-on-year, yet the quarter-on-quarter rise was only about 1.2%, far too modest for an economy seeking to absorb labor, increase investment, and build resilience. This modest growth comes amid a labor market that shows enduring weakness. The unemployment rate stood at 7.4% in Q2, up from around 7.3% in the previous quarter, while the employment rate dropped to 50.66% of the working-age population. Together, these labor indicators signal that a large share of potential workers remain outside stable employment, even as output is growing. Despite GDP growth near 4%, Costa Rica's economy is not creating enough jobs, framing the Q2 situation as stagnation. Growth is hampered by cautious household spending and underwhelming business investment. The 7.4% unemployment rate, alongside a low 50.66% employment rate, reveals deep labor market slack, with recent job growth concentrated in low-wage sectors. Meanwhile, elevated borrowing costs for firms and households constrain investment and hiring. Modest inflation, projected at 1.8% for 2025, reflects this weak demand rather than strong purchasing power. Finally, the high public debt-to-GDP ratio offers the government little room to deploy significant stimulus in response. Public investment is too small to close the unemployment gap, and social transfers only cushion the impact. With high borrowing costs, the state's ability to stimulate the economy is diminished, reinforcing stagnation. The Q2 jobless rate of 7.4% conceals a broader challenge: low employment participation, slow job growth, and high underemployment. Mindful of inflation risks and debt constraints, the central bank and government held back from large-scale stimulus, and this cautious approach did little to shift momentum. In sum, Costa Rica's Q2 performance, GDP growth at 3.9%, unemployment at 7.4%, and employment participation at 50.66%, reflects a stagnation environment. The economy is moving, but too slowly to deliver inclusive job outcomes or robust investment. Absent bold policy steps, the risk is a persistently underperforming economy. Many adults remain inactive or underemployed, particularly in informal sectors or low-productivity roles. Recent job growth is concentrated in services and low-wage informal employment rather than formal high-productivity sectors. Youth unemployment remains significantly higher than the headline figure, while regional disparities mean employment outcomes are weaker in certain provinces. Borrowing costs and credit conditions play a key role in the stagnation story. While official policy rates may not be extraordinarily high, credit spreads, risk premiums, and effective interest rates remain elevated for smaller firms and startups. Many SMEs report difficulty in securing affordable loans for capital outlays or working capital needs, which in turn slows hiring decisions. The combination of modest growth and tight credit reduces investment impetus and job creation capacity in Q2. On public finances, Costa Rica's high debt burden limits policy flexibility in Q2. With debt-to-GDP levels high and forecast to rise absent faster growth, the government cannot afford large stimulus packages without risking sustainability concerns. Public investment, while present, is smaller in scale, relative to the unemployment and investment gaps facing the economy. Social transfers and safety nets help cushion the population, but do not substitute for broad job creation or productivity growth. With borrowing costs for the state still significant, the state's ability to act as a counter-cyclical force is diminished, reinforcing stagnation rather than reversing it. Policy responses in Q2 reflected the constrained environment. The central bank avoided aggressive interest rate cuts, mindful of inflation risks and external financing constraints. The government held back from large-scale stimulus given its debt constraints and opted instead for targeted credit support, modest public investment, and social measures. Without large-scale demand generation or job-rich public investment, the stagnation persisted. Looking ahead from Q2, risks include a protracted period of low growth and elevated unemployment. If GDP growth remains around 3.9% but job creation remains weak, the labor market slack could deepen. With debt to GDP high and rising, fiscal space will shrink further. If credit remains constrained and investment muted, the economy risks drifting into a low-growth trap where unemployment becomes embedded, productivity growth stalls, and living standards lag. On the upside, if the government successfully accelerates public investment in high-employer sectors, renewables, transport, digital infrastructure, lowers borrowing costs for private firms, and reforms labor market training and matching, then Q2 might signal a turning point rather than permanent stagnation. In sum, Costa Rica's Q2 performance, GDP growth at 3.9% YYY, unemployment at 7.4%, employment participation at 50.66%, modest inflation, elevated borrowing costs and high public debt, reflects a stagnation environment, growth that is positive but insufficient to generate broad employment or productivity gains, combined with labor market slack and limited policy buffers. The term economic stagnation aptly describes the Q2 phase. The economy is moving, but too slowly to deliver inclusive job outcomes, robust investment or structural upgrade. Absent bold policy steps and structural reform, the risk is not a temporary slowdown but a persistently underperforming quarter leading into a longer period of subdued growth. Costa Rica's economy in the second quarter of 2025 delivered a performance that underlines stagnation rather than dynamic growth. Real GDP expanded by 3.9% year-on-year, yet the quarter-on-quarter rise was only about 1.2%, far too modest for an economy seeking to absorb labor, increase investment, and build resilience. This modest growth comes amid a labor market that shows enduring weakness. The unemployment rate stood at 7.4% in Q2, up from around 7.3% in the previous quarter, while the employment rate dropped to 50.66% of the working-age population. Together, these labor indicators signal that a large share of potential workers remain outside stable employment, even as output is growing. Although detailed official data on the policy interest rate is limited, effective borrowing costs for firms and households remain elevated, constraining investment and hiring. Inflation in 2025 is projected at 1.8% for the year and about 2.5% for 2026, reflecting subdued demand and limited wage price pressure. From a fiscal standpoint, Costa Rica's public debt-to-GDP ratio remains high and rising, offering the government little room to deploy significant stimulus in response to stagnation. The combination of moderate growth, high unemployment, and elevated debt burdens frames the Q2 situation squarely as stagnation. Despite GDP growth near 4%, the economy is not scaling fast enough to generate broad-based job creation. Private consumption, typically a key driver of growth in Costa Rica, has cooled. Households remain cautious about discretionary spending, constrained by modest real wage growth and labor market insecurity. Business investment also remains underwhelming. Even though some infrastructure and energy projects are moving forward, firms cite financing cost concerns and demand uncertainty as reasons to delay expansion. External demand in key exports remains supportive but is insufficient to offset weakness in domestic demand and investment. As a result, the net contribution from external sectors in Q2 was limited, and imports rose relative to exports, reducing net external demand stimulus. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.